Some people seem to think that you can't beat the stock market because there's such a large number of experts out there that are researching and analyzing companies all day long, really. So in this video, we're going to take a look at what dividend stocks these so-called experts are recommending, and I'll give some thoughts on the stocks as well and hopefully create some discussion. So I found this article here on CNBC that was published just a few days ago on September 10th, and it discusses 5 dividend stocks that are described as attractive, and they were picked by top Wall Street analysts to enhance returns. So the first expert is Michael Rollins. He works for Citi and he has a success rate of about 65%, and he ranks 298th out of the 8,500 analysts that are ranked on this TipRanks website. So I'm hoping he knows what he's talking about. The company he actually highlighted was Verizon, ticker symbol VZ. And he did mention, although there are many headwinds in the telecom industry, the competitive environment is showing signs of stabilization that he believes would help operating performance over the next few years. He did raise his price target $1 to $40 per share, which is about 17% higher than the current share price of $34. And another thing that's notably attractive for some investors is the relatively juicy dividend yield of almost 8%. For me, though, the unattractive part really is the low dividend growth rate of only 2% on average over the last 5 years, and that's really been consistent over a longer period of time as well. I think if you are maybe looking just for a generally solid company that will likely preserve your capital and provide a higher amount of income, then I guess Verizon could be a decent choice. But if you're more of a longer term investor that is interested in some sort of growth and capital appreciation and total returns, then Verizon, in my opinion at least, probably isn't the best choice. I definitely agree with Rollins that the stock's a little bit undervalued right now. There are some signs of improvement to come in the industry, but I don't think the price is anything crazy attractive, given the large amounts of debt they have. And like I said, there's just much better companies out there, I think, for most people and their kind of goals with investing, but everyone is certainly different. The next expert on the list is Rick Wise, and he has a success rate of 58% and is ranked 729th on this website. He recommended Medtronic stock, ticker symbol MDT. After their fiscal Q1 results, he says that continued recovery in elective procedure volumes, supply chain improvements, and product launches will help drive outperformance across the business. He did raise his price target a little bit to $95 per share, which is 17% higher than the current share price of around $81. I don't really know a ton about Medtronic, but at first glance, I am attracted to their strong balance sheet. Right now, they have more net income in a typical year than they have long-term debt, which is an awesome sign to see. Their revenue and earnings haven't really been growing that much in recent years, which is a trend we definitely don't want to see continue. They do have a solid dividend profile with a yield about 3% and a 5-year dividend CAGR nearing 8%, which is pretty solid, I think. And they do have 47 consecutive years of dividend increases, contrary to what Seeking Alpha is saying here. So I think Medtronic is a solid company. The valuation seems fair, maybe a little bit undervalued, but not super attractive in my opinion. But this would be something I would have to do a little bit more research on before being more confident in that conclusion. The next analyst here is Drew Crum, who has a 59% success rate and is ranked 322nd on the website. He recommends Hasbro stock, and he seems to be quite bullish for sure, as he actually increased his price target from $79 to $94 per share, and that's a 34% premium above the current price of about $70. Hasbro has definitely been a laggard recently. The stock is down about 33% over the past 5 years, and their earnings have definitely fallen off. And they actually reported negative earnings in the last 3 consecutive quarters, which is definitely not a good sign. Crum does see some, positives in the business. He thinks portfolio adjustments, cost discipline, focus on gaming and licensing, and new management as catalysts for higher earnings power in the future. But this is definitely a bit of a turnaround play. It might be difficult for them, I think, as well to get that business turned around with all the debt they have right now on their balance sheet, which is between 5 and 10 times a typical year of net income. And increasing interest rates is just going to make that even more burdensome. They do have a bit of a higher dividend yield right now of about 4%, and the 5-year dividend growth rate is quite low at only 3% on average. A little bit of backstory on that. They did grow the dividend pretty quickly between 2010 and 2020 at an average rate of around 13% per year. But the issue with that is their earnings really didn't increase to support that dividend growth. So since 2020, they've only raised the dividend once. And as a result, I really don't expect their future dividend increases, if any, to be very significant for the next few years at least. So I can't say Hasbro looks all that attractive to me. Their debt just looks way too high for my liking, and the dividend isn't super sustainable or with very much growth potential. The business is really faltering, I think, and it doesn't really seem like the valuation is all that attractive either. Amit Daryanani is our next expert analyst, and he has a 60% success rate and ranks 249th. He recommended Dell stock and increased his price target from around $60 per share to $70 per share, which is actually slightly below the current price of about $71. Their recent second quarter results far outpaced Wall Street's estimates, and the stock surged on the news and really hasn't fallen off since. So Amit sees strength in their infrastructure and client segments both, especially in GPU-enabled servers and the potential for AI-related revenue in the future. These are certainly all fair points that I think are positives for the business. But like I've said before, I think kind of the utility of AI and revenue and profitability of AI is going to take a little bit longer to play out than some people seem to be saying, at least in my opinion. And the valuation right now isn't all that great for Dell as well. They do have a lower dividend yield of about 2%, and they raised the dividend this year but by about 12%, but that was the first dividend raise. They're pretty new to the dividend game, so it's a little hard to understand or predict what they might do with the dividend. I think they might, grow it kind of quickly over the next few years. They have lots of room to grow it, but I wouldn't expect, a double-digit growth rate for multiple years on end. I do think Dell is a solid business, and the case could be made that it's undervalued, but I don't really think it's all that attractive right now for me personally, given my goals. Last on our list here is Peter Benedict, who picked the massive company of Walmart. Benedict actually has a 68% success rate and is ranked 94th on the website, which is the highest rating we've seen today. He did raise his price target to $180 per share following the company's upbeat second quarter earnings results, which is 9% above the current price of $165. And this price target assumes, he said, a PE ratio of 23 on fiscal year 2025 earnings, which is above their 5-year average PE of around 22. Unlike some of the other companies we have discussed, Walmart has a great history of growing their revenue pretty consistently, but they have struggled a little bit in recent years to continue that trend into their earnings. Their debt is also a little bit high for my liking, but aside from that, it's really a great company. As an investment, however, Walmart, again, falls short in my opinion. It seems to me like the company is always overvalued, and right now at around $165 per share, it does look expensive still. From the dividend side, the yield is pretty low, and the dividend growth rate is low as well. Both of those are around 2%, which is really not what you want to see in my opinion. I would really like that dividend growth rate to be much higher, but like we've looked at with the earnings don't really support a dividend growth rate that is, all that much higher at least. However, they do have consistency with the dividends. They have 51 consecutive years of dividend increases, which does make them a dividend king, which is a awesome milestone to achieve. But overall, I've just never been the biggest fan of Walmart as an investment, particularly for kind of the basic reasons I've laid out, and nothing, recently has really changed much on that perspective. So just to recap, the 5 companies we discussed here were Verizon, Medtronic, Hasbro, Dell, and Walmart. And of those 5, I would say 3 are fairly good companies, I think, being Medtronic, Dell, and Walmart. However, even among those 3, none of them really seem to be at super appealing valuations at the moment, in my opinion. I would say Medtronic is probably the most attractive to me right now, but it's still not, super appealing. To be frank, I was a little bit disappointed with these analyst picks and recommendations. From what I can see, Hasbro is almost spinning out of control at this point with really no sign of, recovery or turnaround in sight. And Verizon really doesn't look like it's going much of anywhere very quickly. But I would love to hear what you all think of these specific companies and the analysts' thoughts on them. I usually don't really look at all at what analysts or the quote unquote experts are saying. But if you do look at those kinds of things, I would be interested to hear what resources you use and kind of how well you think those resources have helped you. If you do have any questions, comments, or concerns, please let me know in the comments below and join the free Discord as well, which will be linked in the description. Thanks for watching, and I'll see you all in the next one.